Karthik Kumar is with us, fund manager at Axis Mutual Fund. Karthik, good morning. Good to have you with us here. You know, the market's just completely flipped from everything is lost and we're going to be in an uncertain world now for the next 4 years to everything is fixed. And stocks have snapped back like anything, right? I mean, in many cases, 20, 25, 30%, very, very quickly. Where that puts us once again in a tricky situation. To begin with, India is the best place to get a deal, but I mean a bilateral trade deal. I don't know the quickest it's been done in, but it's certainly not weeks. It's got to be in months. What is your sense, Karthik, as you look at and analyze the market situation for now?
You're absolutely right. So from an house perspective, we believe that the markets will be range bound for a while. See, some of the positive things that we've seen over the last few weeks is lower oil prices, lower commodity prices, US dollar weakening, and incrementally lower selling from FIIs. In fact, they've turned buyers recently. So all those are the drivers. But having said that, those positives are balanced out by the fact that there is still tariff uncertainty. Markets can digest good and bad news, but uncertainty is something that it doesn't like. And this earnings quarter is also likely to be subdued. Putting both those things together, I think while we've seen sharp corrections and a recovery subsequently, I think the market's more likely to be range bound going forward for these reasons.
Okay. Karthik, hi. Good to have you on. Good morning. So what's the sense? The thing is that the pullback rally in India has also been, fairly ferocious and quick, but we're still 6-7% off the peak. So it's not like we've recovered all the losses. 26,000 is still some time away. Do you see this current pullback move continuing to those highs, old highs?
I said it's difficult to put a marker there, but having said that, I think the fact that it's still below its all-time high reflects the fact that we are seeing a subdued earnings seasons. There are still earning cuts for the current and the next financial that we are seeing. In fact, the entire breadth of market has seen sharp earnings cuts over the last 3 months. The breadth of earnings revisions is probably at its peak. I think looking at the data going forward, the degree of revisions should start easing off, and the pace of earnings cuts should kind of slow down. But having said that, it reflects the uncertainties and the fact that we are having a subdued earnings season, and that's why we are probably not there at close to all-time highs. But having said that, it's difficult to put a marker there.
Hi, Karthik. Good morning and good to see you in. Nigel on this side. Karthik, I think the last time we chatted, you were talking about you were quite positive on healthcare, pharma names as well, while you were relatively underweight on the staples, and that has been the trend actually for the last couple of, months or so. What's your view on staples, though? A couple of sell-side notes have come in, and they are suggesting that maybe now the bad news is in the price. That could be the pocket to hide, and maybe consumption will improve. So from the consumption basket, do you all actually like discretionary and you're underweight on staples? Or do you all believe now that maybe the bad news is in the price, so staples is also a pocket you all could look at?
We still are selectively have better representation in consumer and discretionary space rather than the staples space. Yes, the staples have kind of lagged over the last few months. But having said that, the earnings expectations and the earnings revisions still reflects the fact that the environment is not back to what it should be, and the growth is not yet fully there. So, which is why, for those reasons, we find there are better pockets within the discretionary space rather than the staple space. So we continue to keep our position, which is being selectively overweight discretionary, selective areas of discretionary, whereas continue to remain underweight staples. And while valuation on an absolute basis compared to their own history might have come off a bit, but relative to markets, relative to other sectors, it's still on the higher side.
Okay. Karthik, we were talking about the market recovery. Obviously, two sectors which are global facing, they have recovered the least, and that's IT and metals, right, for obvious reasons. I want to get your take on IT. Yesterday, the stocks were rallying as if, it's blue skies and all troubles are over. Nobody was looking at the really subpar Q4 performance, saying it's already in the price. Today is a slightly more measured day. what's the call you're taking on large cap Indian IT services?
I mean, over the last few days have been volatile, but notwithstanding that, essentially we remain close to neutral to slightly underweight on IT, depending on the funds that you're talking about. Yeah, I mean. Some of the uncertainty with regards to the earnings environment for the tech sector, the uncertainty with regards to tariff and its flow through on IT is also reflected in the fact that the sector and the stocks have underperformed substantially over the last 3 to 4 months. So one could argue that part of it is a good part of it is in the price, and so to that extent, what we may see going forward may not be this level of underperformance that we've experienced recently. So we continue to remain underweight to slight neutral to slight underweight, depending on the funds that you're talking about. Metals is a different story altogether. We still continue to remain underweight metals, and that's more a take on what is happening globally, and that is also reflected in the earnings expectation environment that we see across.
No, I got it. By the way, Karthik, any large price dislocation still where the market is, sold off stocks aggressively in anticipation that demand commentary, etc., will weaken, whereas maybe in your assessment where that is not the case. So, any large dislocations right now?
From a quantitative perspective, what we saw was initially coming into 2025, given the uncertainty, markets really gave up on growth and momentum, so to say, because there was uncertainty in the environment, and growth numbers were kind of market turned skeptical on some of the high growth stocks, and that took a severe beating in Jan and Feb. But what we are seeing right now is market being a bit more discriminating between growth stocks and looking at growth stocks where it is actually feasible. So some of the dislocation that we'd seen back in January and February, where market took umbrage under, let's say, low vol and low risk and shunned growth areas, that is kind of somewhat unwinding, where again we are looking at selective areas within growth and markets bit more constructive depending on where it is positioned within the growth segment, whether it's external, internal, and so on and so forth. So I think we are beginning to see that discrimination, which was not the case before.
Okay. All right, Karthik, thank you very much. We'll leave it on that note. Appreciate you being with us on the show today.